Your views on the central bank's decision to keep rates unchanged, was it a wise move?
Yeah, I think it was very much expected. If we look at the local situation in Namibia, the domestic situation, and you compare it to the rest of the world, I mean, we haven't expected anything different. And you will also notice that this statement is very much in line with the previous one. And I suppose the next one will also look very similar. So no real news in this latest statement, and no real surprises.
I mean, October inflation came in at 6.1%, and inflationary pressures persist. So there's almost parity between the interest rates, the benchmark rate, and the inflation rate. And there is a sense that to save the currency, to make the economy look attractive, they have to move.
Well, you know, although the inflation rate was highlighted as one of the factors that they're looking at, it was always the philosophy of the Bank of Namibia to basically focus on only two issues, and that is the private credit extension and foreign reserves. They also always argue that, you know, inflation is basically imported from South Africa, and there's not much that they can do locally to really address that issue. So they basically hope that South Africa will take care of the inflation rate and focus on credit extension, and see if that's not going out of hand, and well as foreign reserves, to have enough foreign reserves in hand to secure the peg with the SA Rand.
Is everything being done to keep the Namibian dollar stable? Because there is a bit of Rand volatility. Although we're seeing the Rand a little bit resilient, the fact is it does have upward and downward swings. So in terms of building up the war chest and keeping the Namibian dollar stable, some interventions have to be made within Namibia.
Well, you know, there's free flow of capital between South Africa and Namibia. The Namibian dollar is one-to-one with the SA Rand. So we experience the same volatility as the SA Rand. And I mean, the Namibian economy is so small that there's not much that they can do to really have a buffer against any volatility. At this stage, you know, the requirement to be pegged on the SA Rand is to have enough foreign reserves, you know, for money in circulation, which is about 2 billion Namibia dollars. Currently, the foreign reserves is about 11, 12 billion in that range. So there's really sufficient foreign reserves to take care of that.
The MPC also considered the current state of the global economy, sluggish growth, rising unemployment in Europe, declining growth in China as variables that they needed to consider. How's Namibia impacted?
Well, very much. You know, our export as percentage of GDP ranges between 40 and 60% depending on the year that you're looking at. We're very much dependent on what's happening in the rest of the world. And obviously, you know, if we just take the different sectors, tourism is very much dependent on Europe and the US. The fishing industry is very much dependent on what's happening in Spain. Commodities very much dependent on China. So the Namibian economy is very, very exposed to what's happening in the rest of the world.
The tacit growth mandate that by not raising interest rates, they're also hoping to stimulate a little bit more retail activity, consumption domestically. What will be the drivers of growth inside of Namibia?
Well, one must look back at, you know, the budget statement earlier this year in March when the government announced this huge deficit and capital and even current expenditure growth for the next 3 years, where public debt, you know, will increase by about 20-odd billion over the next 3 years. So there's definitely a strong drive from government to create jobs, to see how they can stimulate the local economy. And I think, you know, that will also be the philosophy of the central bank, you know, that they also want to give their part in try to stimulate the economy. And because the main issue at this stage in Namibia is not really inflation, but it's employment. So by raising interest rate at this point in time will really not help creating jobs. So I think the focus will be on job creation, on how to stimulate the economy. I think, you know, if you look at the inflation outlook, it's currently just over 6%. I think the central bank is also not too worried about that. Our own in-house projection for inflation is about 7% year-end and about 8% towards the end of next year. So we don't see any inflation rate going out of hand over the next 12 months or so. So I think the focus will be on how to stimulate the economy and to create jobs.
I mean, the forecast for growth is 4.1%, and we're told that that's even an ambitious estimate. It's probably not going to be that. Policy-wise, what are authorities saying about making growth so buoyant that they create jobs. In South Africa, for instance, we need growth of over 6% if we're even to dent the unemployment figures. I would anticipate that it's even more severe in Namibia.
Yeah, definitely so. I think I think we need a growth rate of between 7 to 8%, to make sure that the current imbalances are addressed. So, that 4%, and even next year, we expect growth rate to be around 5% with this huge government spending coming through. But even that is not sufficient to create enough jobs and to make sure that we have an equal economic development and growth going forward.